What does today's CPI report mean for mortgage rates? Today's CPI report came in lower than expected, even though headline inflation increased to 3.2% from 3% last month because of baseline effects. That's the first increase after 12 straight months of decreases. Core inflation, which excludes food and energy, came in at 4.7% versus expectations of 4.8%. We still have a ways to go to get to the Fed's 2% target inflation rate, but we're moving quickly in the right direction. 3-month annualized CPI dropped to 2.3% versus 2.7% last month, and 3-month annualized core CPI dropped to 4.1% versus 4.7% last month. As I pointed out in previous videos, the sharp decrease in M2 money supply is putting a damper on inflation. The Fed has indicated that they're near the end of their rate hikes, which affects short-term rates. The yield curve remains steeply inverted, with short-term rates remaining much higher than long-term rates. Normally, near the end of the Fed rate hiking cycle, we'd expect long-term rates to drop. But the Fed has said they'll keep short-term rates higher for longer. For the yield curve to flatten, with short-term rates staying high, long-term rates would need to rise. What does this mean for mortgage rates? The spread between mortgage rates and long-term treasury rates has widened dramatically. So even if long-term rates overall move up, mortgage rates could remain stable or even decline as the spread returns to normal levels. The bottom line is we likely will see lower mortgage rates within the next couple of years, but they may not drop significantly anytime soon if the Fed really does keep short-term rates higher for longer. If the economy weakens, they may be forced to cut rates earlier than they say. Historically, the Fed has started cutting rates within 6 months after they finish hiking. Will this time be different? Only time will tell. Please like and subscribe for a lot more useful information to come.